There is a sentence buried inside Freddie Mac's 2026 mortgage securities documentation that most Americans will probably never read. Freddie says some alternative financing arrangements may include arrangements designed to comply with Islamic law. That raises a much more interesting question than the outrage cycle around the phrase Sharia mortgage. How does a financial product built around Islamic restrictions on interest get translated into the American mortgage system and eventually into a federally supported secondary market? On August 13th, 2026, Federal Housing Finance Agency Director William Pulte, who oversees Fannie Mae and Freddie Mac, responded publicly to a post about Sharia-compliant home financing. His response was simple: "We are looking into this right now. Thanks for mentioning." As of this recording, I have not found a public FHFA order terminating or suspending the arrangements. So the important thing right now is to understand what officials are actually looking at, because this system did not appear yesterday. It has been developing for more than 2 decades. One of the major U.S. providers is Guidance Residential. Guidance says its declining balance co-ownership model came out of roughly 3 years of research and development involving 18 law firms and Islamic finance scholars. The religious constraint is straightforward. The product is designed to avoid a conventional interest-bearing structure, or riba. Instead, the transaction is described as a form of declining co-ownership. The customer gradually acquires the provider's share of the home over time. But religious compliance was only half of the engineering problem. The other half was making the product function inside American property law, underwriting, security instruments, servicing, and crucially, the secondary mortgage market. Guidance says it has now provided more than $10 billion in financing to more than 40,000 families. And the design has names. A 2003 U.S. patent application titled Declining Balance Co-Ownership Financing Arrangement lists Mohammed Hamor, Harvey Weiner, and James Milano as inventors, with Guidance Financial Group as the original assignee. The application was abandoned. It did not become an issued patent, but the filing is still extremely useful because it shows what the designers were trying to build. The document explicitly contemplates transferring an interest in the transaction to a secondary market investor, and it gives examples, including Freddie Mac, Fannie Mae, or an investment banker. It was contemplated in the architecture itself. Then there is the regulatory language. In 2005, the Massachusetts Department of Revenue issued Letter Ruling 05-3 on the guidance structure. The ruling describes the customer's monthly payment as having 2 components. The first is the profit payment, which the state calls the monetary equivalent of the interest portion of a conventional mortgage loan. The second is the acquisition payment, which increases the customer's ownership share and is structured to simulate principal amortization under a traditional mortgage loan. The same ruling follows the transaction into Freddie Mac and says Freddie treats the relevant documents in a manner similar to other mortgage transactions in its system. Guidance itself says it worked with Freddie Mac and the law firms to create a structure that could satisfy its Sharia requirements while still entering the secondary market. Guidance describes Freddie as an additional investor in the arrangement and says it is the only U.S. provider permitted to deliver its specific declining balance co-ownership structure to Freddie Mac. There is an important nuance here. A Massachusetts ruling describes Freddie as a secured party rather than a co-owner, so it would not treat the provider's marketing description as identical to the legal characterization in every document. But the larger architecture is clear. The structure was adapted so it could move through American mortgage machinery. That access matters because a secondary market allows capital to be recycled into new originations instead of remaining tied up in a single transaction for decades. And then there is one document title that is unusually explicit. In the residential capital bankruptcy records, a contract schedule lists a 2005 client contract between Residential Funding Corporation and Guidance Residential. Immediately after it is a second entry, Shariah Transaction Amendment, dated August 17, 2006. The public schedule proves the amendment existed. It does not give us the full text of the amendment, so we cannot responsibly claim which specific contract terms it changed. But as a historical breadcrumb, it matters because it shows Sharia-specific contractual engineering appearing directly in the paper trail of the U.S. mortgage industry. I have not found evidence of a special federal interest rate subsidy given to someone merely because they choose Sharia-compliant financing. Guidance says its usage or profit rate is benchmarked against prevailing market rates. It does advertise contractual differences, including a non-recourse commitment, capped late fees, no prepayment penalty, and certain risk-sharing features. But the larger system-level advantage is not a secret discounted mortgage. It is market access. A specialized religious finance product was engineered to gain access to the deep liquidity of the American secondary mortgage system. So when people ask, how does Sharia mortgages get into the U.S. housing system? The answer is sitting in the documents. Lawyers, Islamic finance scholars, product designers, mortgage intermediaries, and federal housing institutions built an interface between two systems. Now Washington says it is looking into the arrangement. The story is not that American mortgage law vanished. The story is that a Sharia-designed product was translated so it could operate inside American mortgage infrastructure. I put the primary documents, screenshots, and full source trail into a permanent field dossier at the Lyman Archive. If you want to see the receipts yourself, start there.